to Metals and Momentum. My name's Anthony, and in my last couple videos, we've been talking about how we're going to see a rotation from high risk to the high dividend paying safe haven kind of assets. And right now we are actually seeing that happen in the market. Well, this is very clear now. Like it was not so clear that it was going to come when I posted about this. I believe it was on June 3rd. So almost a month ago now, I posted a video talking about how there was going to be a rotation of capital from the high risk, high reward type of stocks, like for example the semiconductors, and then moving over into something like XLP, or that is like XLP is the consumer staple type of ETF, and we are actually seeing that happen right now. We're seeing a lot of the dividend stocks catch a bid as capital rotates out of SOX and the semiconductors. It moves over into those high dividend paying safety kind of plays, and this is not like it's no longer in question is this going to happen? No. It is, and it has been happening over the past little while. And it's crazy to think about that I posted my last video on June 3rd. That's got quite a bit of views now. I mean, we're seeing that play out perfectly. So let's start just working my way down the list here on the things that I want to go over. Let's start with the SPX. This is the S&P 500. I've got this switched over to a logarithmic chart because I laid this support line, and look at how far back this support line actually goes, right? So if you go all the way back, this is the high in 2022. There is another intersection right around here. This goes all the way back. Like, look at this. This is the January 08. Oh my goodness. That's a long trend line that just keeps going. And then look at that, even into 02, you got that tapping that support line right there. When it breaks above, that becomes resistance. So you got like a little pump, tries to break above, fails, continues its low down that way. But look at how far back this kind of support line goes. And when you get up into like the recent time frame, so this is what we were looking at just recently here, we saw a big break above this support line, or now support line, and we've tried to retest it essentially twice right here. So what I find interesting is at the beginning of 2026, we saw a rotation of capital from the broad markets, from like high risk into the dividend paying safe haven type of stocks. We were actually seeing XLP get a little boost at the very beginning of the year, right? Like this was the beginning of 2026. This is January, right? So you get this huge pump into XLP, and you know, that was your signal that you should have got a little bit more defensive. And also you saw that rounded top forming. I was charting this, right? Like we get this big rounded top right area right here, and then you go into a decline. That's what I was monitoring at the beginning of 2026. Well, what is happening right around here? Well, you're also getting a rounded top, a little bit more of a sharper top. On the S&P 500 right here. You have multiple hits back at the beginning in 2025, and then 2026, and then you start to roll over. Well, right now we're actually seeing a little bit of a sharper kind of top right in the chart on the S&P 500, and this has come after like a massive move in the S&P 500. So this downturn of like 5% or whatever it is that's going to take place, like this should be expected. Like the S&P 500 has been on like an absolute tear. But what you can actually see right now is this is being confirmed with where the market is actually rotating. So we're seeing that pump into XLP, just like we saw in the early 2026. You can see that major pullback. This is where everybody was piling into the SOX ETF right on around this area. And we just seen a massive move in the SOX index But slowly, since essentially, when is this? This was April. We've seen a little bit of that rotation into XLP. And this is the safe haven type of dividend stocks, and it's no mystery as to why that's happening, because, well, generally big money doesn't leave the market. What they do is just rotate their capital from one sector, high risk, to another, safety, dividend paying stocks. They don't necessarily leave the market, but that's where you start to get these larger corrections. So a couple things that are very interesting. One, this is this green line that goes all the way back to like '02. This is acting as support right now. So this is what's holding the market up. You've seen it kind of tap right around here, get a bounce, tap right around here, get a bounce. And all of these, like, these are essentially like fake out. These are fake breakdowns, right? Like they're trying to break down, but then they're coming right back up. What I'm looking for is a further breakdown and a confirmed breakdown on the S&P 500. So you'd get one candle below, like we did here in the past. So you got the breakdown, but then you would actually close lower than that candle that actually breaks down. And that would give you the confirmed breakdown on the S&P 500. But what you could see is very interesting is you get a high. This is your all-time high on the S&P 500, and then a lower high, and then a lower high. But on the bottom here, you have a low, right? And then you have a higher low. So the market right now is trying to figure out which way it's going to go. And basically you've formed this wedge pattern right here. And the market is trying to figure out which way it's going to go. So if it breaks upward, what's the upside? Well, the upside here is actually only a couple percent, like, especially from where we are right here. But let's say we break up to like here, you have 2.76% from the base of this support line. That's your kind of upside. Of course, you could break into all-time highs, and this actually there is a way to figure out how high you would go on the S&P 500, and that's by laying out a Fibonacci chart. And this gives you an exact price point, which I think is really interesting. So here on the Fibonacci chart, you could actually see that the break to the all-time high would actually send us to about 8,000 on the S&P 500. And I think this would, I think there's a somewhat high probability of this happening. It just really depends, I guess, on a number of different things. I think it's going to depend a lot on oil. We're going to look at the oil chart in a moment here. But I think this is going to I think it's the midterms and the Iran war that are going to play a factor in, which direction this is going to go. But if we get that breakdown, how low could we go? I'm just going to get rid of this Fibonacci chart just so I can try and keep this chart somewhat clean. I've got a lot of lines on here already. But how low we can go, really, I think a retracement down to 7,000 would be pretty normal. And it wouldn't happen in a straight line. It's not going to happen like just a straight shot 5% down on a single day or something like that, although it could, but pretty unlikely. We're probably going to get some sideways chop if we kind of break down lower, like let's say right around here. You'd expect like a bounce or two, and then you maybe want to retest like the upper portion of this. You just essentially extend this channel out, and you'd probably like bounce somewhere around like here. And then, from there, you would decide, we would decide, are we going to go lower or are we going to go higher? This would actually be a very bullish pattern if you came back, retested 7,000, and then broke to the upside of this channel here. That would actually be quite healthy, I think, if the market just paused for like a little bit of time and just sat there and like essentially traded sideways for a period of time. Like just go like this for a little bit of time, digest this crazy market moves that have been happening recently, and I think that would be very, very healthy. But if we did break 7,000 is that key level that I'm watching on the S&P 500. If it breaks 7,000, then you want to get very, very defensive. And that's what I would be doing with my own portfolio. I already am pretty defensive right now. If the market, cranked down 5-10% in like a matter of a couple trading days, I'd probably make a lot of money. But I'm really just eyeing that 7,000 kind of level as support for now. But one of the reasons why I have this 11% kind of measurement down to this area here is because you have a gap on the charts, and we know through trading multiple gap fills that what tends to end up happening is you would get this like rise, but then you would get these like bounces, and what tends to happen is you end up eventually coming back and filling this gap. So what do I mean by filling this gap? You would essentially hit this key level right here, and that would be called a gap fill. This would actually make a lot of sense, and that would also be pretty bullish for the S&P 500. Now that being said, you'd be way off the all-time highs, and yeah, you'd get a lot of buy the dippers kind of come in, and you could definitely see something like if you had like a jump down to this kind of area, what you could see is a major boost to 7,000, and then if we roll over and come back down, then I think a lot of people would get really freaked out and start to sell their positions, and that's when you could really lead into a major decline in the S&P 500. But we don't really see that on the chart right now. We could only really predict the short-term kind of move. And right now, I'm leaning more towards a little bit of a breakup, but I'm also aware of the fact that there's going to be about a 5 to 10% correction that could also happen. And in that case, you want to be positioned accordingly. So that's the S&P 500. I think a lot of it is going to come down to midterm elections. Generally, midterm elections are not good for the midterm years are not good for stocks, really. If you look back on history, I think about like 60% of midterm years, and especially when the president is on a second term, then generally you see a down market that year because the market's kind of uncertain. They want to know what's going to happen with the president, like who's going to stay in power. Is like Congress going to just get totally swept by the opposing party or anything like that? And one of the things that I'm thinking about is one of the things that could lead to a major pullback in the S&P 500 is if oil started to rise. Now, one of the things I'm looking at on this is US oil right here. It's WTI. This is the WTI chart, and we are coming into major support right here. In fact, we were almost touching it maybe about like an hour ago or something like that. But we are coming into major support. And one of the things that I'm thinking about is a lot of countries were draining their oil reserves going into the Iran war. And they need to refill their oil reserves, and that would put upward pressure on the price of oil. So if we started to bounce, you probably come in and actually touch this 200-day moving average at a minimum, right? So that would instantly take you up to 73.91-ish. Depending on where that 200-day moving average is at the time. But I think that's at a minimum. That would probably happen. And let's just measure this out just to see. So this is almost like almost a 10% rise, 8 to 10% rise in the price of oil. That would not be insignificant. I think if oil started to run 10% to the upside, you'd probably get interest rates starting to hike, and that would put pressure on stocks. So piecing the puzzles here together, you got oil at support, you got the S&P 500 trying to figure out where it wants to go. If oil starts to rise, then that S&P 500 is going to come down to 7,000 at a minimum, and that is probably going to put pressure on interest rates. We'll look at the 10-year yield in a moment, but I think a 10% move in the price of oil is pretty likely. And then on top of that, you have the Iran war, which is also picking up. Donald Trump says, we're about, if Iran doesn't sign a deal, then they're essentially going to bomb them to oblivion. That's what he keeps saying, right? So this whole setup right here, if you're just reading the tea leaves, this does not bode well for the S&P 500 in my personal opinion. I am super defensive right now. I'm mostly just in inverse shares of a lot of things right now. And I'm long a few things, but those are generally the high dividend paying, beaten down stocks that, are kind of catching a bid right now. So, yeah, I'm kind of positioned for this, right? Like, I think oil is going to make a good little run here. And what would that do to interest rates? This is an interesting chart. Now, I've been projecting, I think interest rates are going to go to 4.8% on the US 10-year. I think the 10-year is like the one to watch if you're going to only watch one. And I've been projecting that, we're going to see 4.8% since back in May. And actually, I think even before that, it was probably somewhere around like here. Let me just get rid of this here. So since like April, I was actually projecting 4.8% on the 10-year. And basically, I was just measuring it out using this bull flag here. So you got the pole to the flag, and then this creates the flag. You get the breakout, and that movement essentially would take you up to 4.8%. We almost got there. We got a little pullback here, but I still think we are looking at what would be almost a double bottom. Not quite exactly how I imagined it on my potential path here, but what I thought was interesting is you got this breakdown, and what this to me looked like was smart money moving back into bonds, because what they're projecting is if interest rates go to 4.8%, which is probably where they're going to go in the near term. If interest rates go to 4.8%, then what that is going to cause is just absolute carnage in the S&P 500. Anything close to 5% is not going to do well for a lot of things. We've already got this private credit type of collapse that's stealthily happening behind the scenes. Nobody's really talking about it. A couple big players are talking about it, but that's collapsing, and that's all due to interest rates rising. And this is going to affect everything a lot more if interest rates go much, much higher than what they are right now. So this setup right here is actually quite interesting. You kind of have a wedge pattern forming. I saw this on the price of oil before the Iran war. So I'm not too sure if the wedge is like this or is the wedge like this. I'm kind of leaning towards this second option here, but you kind of have both on the chart here. So I'm not really ruling out 4.8% if we drop down to right around here. Because once this breaks to the upside, and we almost actually got that here today, look at that red candle here. Now we're probably going to get a drop in interest rates later on in this week, probably because, things are going to kind of rally into the 4th of July weekend, like we're here in Canada today. So in Canada here. So I think we could probably get another pullback in the 10-year. And then stocks would maybe have a little bit of a rally. But then once we start to break to the upside here, if we start to break to the upside, then that's when you get that bigger spike to 4.8% there. So really watching the 10-year very closely. This is interest rates in the US, and a lot of things are going to move off of interest rates going to 4.8%. So paying attention to that closely. One of the things that's been moving to the downside, thanks to interest rates, is gold. I'm just going to get rid of this here, but really I'm watching this red kind of parallel channel forming on the price of gold. We've been watching this for quite some time now. But really what this is a giant bull flag. So bull flags generally trade to the upside at some point in time here. I don't know if it's going to pull back a little bit more and then move to the upside, or is this the bottom here? I'm leaning towards no. And mostly because of what we just talked about in interest rates here, right? My long-term target for gold is actually closer to, it's 8,000, but I think we're eventually going to get to 22,000 as well. But right now, if interest rates continue to rise, then that's going to put pressure on gold, and we could see gold drop another couple $100 or so. But one of the things I'm writing in my bi-weekly report is, are we close enough to the bottom on gold? Like, I've got this measured out here, and you can see that you have this gap right here, this section right here on the gold chart. There's like no support right here. So if we break below 4,000 on the price of gold, I think we're gonna get a quick drop to 3,500 or so. But if you're a long-term type of investor, and if you're willing to, be patient, then I would say we're pretty much close enough to a bottom, for me at least. I mean, I'm already positioned in physical gold. I sold physical silver near the high here, and I think I picked up physical gold somewhere around this general area. I think somewhere around 5,000. So I don't really care about the price. I just think to myself, does my portfolio need it? And I just position ahead of it. I don't trade physical gold like I do my other positions or anything like that. So I personally think we are getting close to the bottom. I could see, another 10% decline. Yeah, I could definitely see that for sure. But is 10% all that big of a deal to you? Probably not, especially if you're a long-term holder like I am. I think, it's smart to have about 15 to 20% in physical gold. That's my current weighting. I'm about like 18% or something like that in physical gold. And I think it's one of the most important assets that you could own in this coming decade. So to me, I'm not going to trade it. I think we are close enough to a bottom. If I didn't own any, I would begin accumulating right now. And then if we dropped, say, 5%, then I would just double my position or something like that, and then I would trade it at like that. But I'll write my strategy if I owned no physical gold in this coming newsletter that's coming out on Saturday. So links in the description if you want to subscribe to my Substack. There's a free version. This whole article is going to be written for free. And then there's a paid tier as well. It's $9 a month over on Substack. Let's move on to silver. Silver is getting very, very interesting. We are pretty much at key support here. A little bit more downside. And I'm just thinking about what is the upside versus the downside here. I think the upside is about 11%. Maybe even 6%, so not that high. But the downside here is probably closer to $46. I think this 54 level is it's key support. I knew there was going to be a bounce somewhere around $54, and it looks like we're actually getting that bounce right now. I would have thought we would have, hit that key support around $54, maybe $55, and then had the bounce. But it looks like we're seeing that little bit of a bounce happen right now, and I don't think this is going to last. If you zoom in on the candles here, and I'll just get rid of this, what you could actually see here. This is a bear flag. So you got a big drawdown, and then you're flagging to the upside here. And this is a pretty aggressive slope here. So this is why I'm thinking it's probably not going to last. And I don't even think we're going to hit $64, but we could, we could hit about 63.50, let's call it, and then come down. So maybe we just trade like sideways somewhere around like here for a little bit of time. But I don't think this is going to play out like that. I don't think actually it has enough strength. I think a lot of people are super bummed out about physical silver, and they're looking to exit on any rally, and we're seeing a little bit of selling happening even in this slight rally right here. Oversold to the downside probably, but at the same time, the way that this could work off being oversold is just trading sideways. So the risk to the downside right here is pretty large, and I think 54 is a given. If we break 54, we're going to jump quickly to $46, and at $46, like, I would be very interested in physical silver at $46. So I would be a buyer at 46. 39 is the next support line underneath that. So this right here, this would be a total gift, and I would probably reposition like totally in physical silver at that point in time there. But we'll see what happens. We'll watch that $54 level and go from there. One of the other charts that I think is really interesting right now, wheat is very interesting. We're very close to a resistance point right here. We're not far off. Let me just take a look at where we are. right here. So we're about this is a very slow moving asset. So, I'm measuring out 3.64%, but that could happen over the course of like 3 days or something like that. This is a very slow moving asset, only 2.93% to the downside. That's the 200-day moving average and a key support level as well. So technically speaking, wheat is still in an uptrend. You got that upsloping 200-day moving average happening right here, but this is very early in a potential move here. I would like to ensure we break above 23.33 23.33 or something like that before I position myself. But if I had extra capital, I'd probably already be in wheat. But I'm just trying to keep things open, trying to view what is the best place for my capital right now, because I'm sitting on about 14% cash or something like that right now. So I'm looking for I'm just looking to make sure that I deploy in like the best opportunities. If I was flush with cash right now, I would be in wheat 100%. Same with corn. I would also be positioned in corn, although technically speaking, we are in a downtrend here. So the only thing that's kind of making me think like, oh, this is good. This is actually kind of interesting as a play. If I was a little bit more flush with cash, is we are holding 1661 as a key support zone right here. This support line goes all the way back. Like we're talking, there's 2017. I even took this back even further. Did I go back further? Maybe not. Oh, okay. Maybe it's just the corn fund. Yeah, the corn fund doesn't go back all the way that far. But 1661 is key support level for me. Right now we're sitting at a little bit of resistance, but the thing that I'm kind of interested in corn because of this is because of that Iran war. If this Iran war starts to pump up again, you're going to see a pump in wheat and corn, and it's going to be aggressive to the upside. Even though this is a very slow moving asset, we've seen wheat and corn gap up multiple times in the chart, not only recently, but going back into the past as well. You've seen multiple gaps up and where you're jumping, like you're closing the day one day and then jumping up 4% overnight, and then moving another 5 or 10% to the upside here. So if we break through resistance, you got 5.8% to the upside here, which is actually quite nice. Right now, from where we're at right here, very little downside. You got 1.76% to the downside. I think wheat and corn are going to be interesting commodities to watch. Even if we go into a recession because of this Iran war. And I mean, if oil stays around 75 to 65, maybe $95 or something like that, you're going to see a boost in those wheat and corn prices. And a lot of Asian countries right now, they are wanting to accumulate these soft commodities. They have to import these soft commodities into their country. And the Middle East is all blocked up right now. So I'm kind of bullish on wheat and corn, although corn is technically in a downtrend under that 200-day moving average here. Let's look at XLP. So I mentioned this, big money is rotating into XLP. You're seeing that 200-day moving average slope up for a little bit of time now. And we've just been holding this area, really holding in the green channel here for a little bit of time, and kind of creating a little bit of a wedge right here highlighted in white. This is an interesting chart because, every time right before you see a down move in the S&P 500, you generally see a rotation into these consumer staple type of stocks. And that's one of the reasons why I'm so interested in this. We've already played this once or twice. I actually exited right after this topping tail, sent a trade notification right around here, and said that maybe somewhere around here, and said that's a topping tail on the chart. We need to get the heck out. And since then, we've pulled back. So maybe I might re-enter into this if we come back down a little bit further here. But two kind of levels of support. One is the white line, one is the green line here, and this is just coming back from the bottom in 2026. There's January, and then late 20 2025, you almost touched it right there as well. But really, that January 2026 bottom takes you all the way up to right around here in this general area right there. So 2 levels of support I'm watching. Let's go over to semiconductors, because the semiconductors is essentially the market right now. Very concentrated in the semiconductors, but I think we have topped on the semiconductors. I think this right here is the top. I was watching this, these white lines right here. This is like an upward sloping wedge, which generally does play out to the downside. And I saw this breakup happen yesterday. And I was like, wow, big move in the SOX, but no confirmation. We'll see what happens today. Yesterday, it was tomorrow. And what we were seeing in the SOX semiconductor ETF is you're actually you're not actually confirming that move to the upside here. So no follow through, big move down on the semiconductors, down 5.72% right now, which is really, really crazy. That's a big move in a single day, especially because volume right now is kind of light. And when volume is light, it's generally retail buyers stepping into the market and moving the price up. That's what I thought was happening yesterday on the chart. I was seeing that big spike and I'm like, I'm not going to sweat this move here. This is probably just retail buyers. Maybe we get some follow through tomorrow. But no, we're getting slammed here. And partly this move was due to the fact that Facebook, Meta, just came out with an announcement that says they're flush with chips right now, and they're going to have to start selling off some of their chips. They have too many. And I was thinking to myself, like, this is the first time that we heard any company saying we have way too many chips and we're going to start to sell off some of our chips right now. This is bad news for the semiconductors. And this is why I think we're about to confirm a rollover. When would we actually confirm a rollover? Well, I want to see a breakdown of this level right here and a breakdown underneath this white level. And once we break underneath that white trend line here, we're going to slam right down to this area of support. And that's where I'm going to start to expect a bounce and then a continued move lower. And one of the things that we can actually chart out now is we can extend this all the way down here. And this is kind of tough. Yeah, maybe if we were to bounce, you'd probably expect a bounce like this. So we'd move lower, slam here, slam the upper side of that white trend line and this underside of that trend line, come back down here, and maybe you make one move back up to this general direction, and then you see the hard sell off there. So I'm going to be paying close attention to this, and I am going to monitor the charts over the next little while because right now I am very inverse on the semiconductors, and we're seeing that rollover happen in real time. One of the things that I'm kind of watching is this a head and shoulders pattern forming on the chart right here? And check this out. Here's the head, here's the shoulder. We're waiting on this other shoulder to kind of play out here, and it maybe would look something more like this. And we could even, probably bounce to right around there. And if we put in something like this, then that would give you a downside target on the semiconductors of about right here. So this would take us down to, let's call it 10,000 on the chart that I'm looking at here, SOX. And yeah, that is a major move, especially from where we are right now. That is a 25% decline on the price of semiconductors, and I think that's going to eventually play out. What you're going to see is once we break one of these key support lines right here, you're going to go into a full-out panic. People are just going to be selling shares like crazy, and you're going to get a very, very large decline very quickly once you break into this general area, and then by the later half of the year, I think we're going to be coming back to about 8,000 or so on 8,500 or so. And that's going to erase this giant move. Look at this on the S&P 500. We saw that gap. Well, what's this? There's a gap upward right here. And we know gaps get filled. Once you get that breakout, you're going to retrace all the way back down here. And that is going to fill the gap right there. So very interesting looking chart. Not a great setup for the semiconductors. We know they're cyclical, and money is already rotating out of semiconductors. Every time we see the semiconductors rally, we see the dividend stocks, the safe haven plays, start to dip. One of the safe haven plays that I've identified is CAG. This is ConAgra, and one of the things that I was watching is you got this downward sloping wedge. This stock is, by the way, paying like 10% dividends, which is unbelievable. What we were seeing is we were watching this wedge pattern. Is a downward sloping wedge. Once that broke, we ended up buying it. We traded the stock to about here. We saw that slam kind of lower, failing to break out of resistance right here, moved out of the stock, small gain on that one. It since came down, touched the top of the wedge pattern, and then started to trade to the upside. And we are seeing fairly significant volume in these types of stocks. Really look at the volume, super light, mostly sellers on the downside here, but we started to see a pickup in volume right around here, and that's when we started to move in. So very key little snag here on CAG. Very interesting, and we're seeing a lot of the other dividend playing stocks get a nice little bid. Let's look at MOO. This is one that I currently am holding right now. And if the volume will load in a sec here, we're also seeing big spike on volume right here. All throughout the last little while, the buying not that high. Like you got little spikes right here, but not that high, right? And next to no sellers right around here. Although the stock started to trade lower, not a ton of people selling, right? And then all of a sudden, big money starts to position into MOO. This is actually forming a bull flag inside of a bull flag. So check this out here. Let me get rid of the volume. And so just zooming out here, you have this bull flag right here. Boom. Bull flag formed on the chart right here. You're getting this like parallel forming right here, right? But that's like the longer term outlook. But then also on the short term outlook, you also have big move to the upside, sideways consolidation. That's also a bull flag. Eventually, I think this is going to break out. And when it breaks out, maybe it's somewhere like this, somewhere around here, and then a breakout, move to the upside. You have a max upside target of about 89.64. That's the top of this chart right here. It would at least take you to all-time highs. That's 86.50, right around there. So very, very interesting things happening in the charts right now, and that's what I'm seeing. I wanted to make a nice long video, get you guys up to date on what's going on in the markets here, because like I said, I've just been positioned already. Like we were positioned over in June, early June. We were well ahead of this movement into the safe haven dividend type of stocks, away from risk. I never got into the SOX index, or never got into these like Nvidia plays or anything like that. Those were just rocketing higher, and the rest of the market was getting left behind. And now we are for sure seeing big money start to rotate into the safe haven plays, and that's a red flag. Like that never happens unless the S&P 500 is going to slowly start to roll over. If big money is concerned, then I think so should you. So that's where I'm going to leave it. Links in the description down to my Substack. There's a free version. The bi-weekly report comes out on Saturday. And then if you subscribe to the paid tier, it's $9 a month. Very inexpensive to subscribe. And you can get get direct access to all of my trade notifications and see what exactly is in my portfolio and when I position in my portfolio in those trades. So thank you so much to the recent subscribers, the free tier and the pay tier, getting both, which is great and fantastic. Thank you so much for joining me. That's where I'm going to leave it. Thanks so much for watching. My name is Anthony, and we'll see you in the next one.